Hello friends and welcome to Study IQ English. We'll be continuing with Chapter 3 of Economic Survey 2021-22, that is External Sector. So let's continue with that. We have seen the overview of this chapter. Also we have seen with regard to merchandise trade of India. Next we are coming to trade agreements. What are the agreements that are in progress, trade agreements that are in progress, and what is the status of those agreements? First, India has initiated negotiations on the following trade agreements. One is CECA, that is the Comprehensive Economic Cooperation Agreement. This is between Australia and India. Comprehensive Economic Cooperation Agreement is between Australia and India. Then FTA is Free Trade Agreement with the European Union. Next is SEPA. SEPA is actually Comprehensive Economic Partnership Agreement. This is with Canada and UAE. So one is with Canada, another one is with UAE. And also apart from that, India is reviewing its already existing CECA with that of Singapore. India is reviewing its existing trade agreements such as CECA with Singapore and ASEAN-India Trade in Goods Agreement. That is with ASEAN. So, India is reviewing it, making changes to it. And free trade agreement with UK also, the government is in negotiation. And these negotiations are complete with the agreement with UAE. That is, SEPA with UAE agreement, negotiations are complete, and the one with Australia, CECA, it is at the final stage. So, these are some of the important trade agreements India is negotiating on, and this is the status of such negotiations. Now coming to some of the major schemes and incentives to promote exports or to boost exports from India. First one is remission of duties and taxes on exported products. That is the remission, that is the taxes and duties on exported products are remitted. So remittance, and this is actually an improvement over the already existing MEIS scheme. MEIS scheme is Merchandise Exports from India scheme. So remission of duties and taxes, this is an improvement over Merchandise Exports from India scheme. Second one is developing district as export hub. Now, developing districts as export hub, that is in every district finding out that one commodity or more commodities which has a export potential. Products with export potential is identified, and thereby increasing or diversifying the export portfolio of the country. That is the purpose of this scheme. Third one is PLI scheme, Production Linked Incentive Scheme. We will be covering this in much detail in the upcoming modules, but just a little bit about the PLI scheme. I think already I have given you an introduction regarding PLI scheme in the previous lectures as well. And I also told you that I'm expecting a question from Production Linked Incentive Scheme in the next year's Civil Services examination. So Production Linked Incentive Scheme or the PLI scheme, last year budget the outlay was 1.97 lakh crore rupee. That is in 2021-22 budget. So what is this? This is actually a production linked incentive. That is incremental production. Whenever a company increases its production, an incremental incentive is given. And this is for 14 key sectors. We'll be covering this in Industry and Infrastructure chapter in detail. Next is Electronic Platform for Preferential Certificate of Origin. This is the next one. So this is an electronic platform for preferential certificate of origin. Why electronic platform? This is in the view of COVID-19 crisis. So this was an electronic issuance. Then next is infusion of capital in Exim Bank. Exim Bank, we know it's an export-import bank. Exim Bank is Export-Import Bank of India. And government has infused 750 crore capital in the Exim Bank during 2021-22. And as we know, Exim Bank, the purpose is to improve or boost the exports and imports. So capital addition or infusion of capital in this Bank means this is an incentive towards export and imports. Next one is Export Credit Guarantee Corporation of India Limited. And what is the purpose of Export Credit Guarantee Corporation? It's a credit guarantee. So from the term guarantee, we can make sure that it is something related to insurance. So basically, the Export Credit Guarantee Corporation of India, it provides insurance coverage to banks against the risk in the export credit. So if a bank is giving some export credit, then this corporation, that is Export Credit Guarantee Corporation of India, provides a kind of insurance against the risk that the banks are providing loans on exports. So that is Export Credit Guarantee Corporation, and again the government has approved 4,400 crore rupees infusion to Export Credit Guarantee Corporation of India. Next one is Export Promotion Capital Goods Scheme, that is EPCG scheme. Purposes: procurement of capital goods from indigenous manufacturers, that is Export Promotion Capital Goods Scheme. So purpose of the scheme is procuring the capital goods from indigenous manufacturers. Indigenous manufacturers. So these are some of the government initiatives and schemes to promote exports. In mains, if a question is asked regarding government initiatives for promoting exports, you can mention a few of them. Then next one is enabling an efficient logistics ecosystem to promote exports. As we know, one of the major factors, push factors for exports is logistics ecosystem of the country. So enabling efficient logistics ecosystem in order to promote or boost the exports. First one is PM Gati Shakti National Master Plan. As we know, PM Gati Shakti Master Plan, it is given a special emphasis in the current year's budget, that is the upcoming budget which is presented recently. So PM Gati Shakti Master Plan was given a focus, and it was considered, or it was given so much importance that it is a flagship program of the government of India. And what is the purpose of PM Gati Shakti Master Plan? It is to provide multi-modal connectivity. So it can provide multi-modal connectivity to various economic zones and also can integrate infrastructure. Then other initiatives for efficient logistics ecosystem: introduction of FASTag for easy transportation, then Turant Customs, easy customs payment, then mandatory RFID, radio frequency identification, then tagging at all EXIM bound containers, e-Sanchit, etc. So these are all some of the initiatives apart from the schemes or the other initiatives. Next we are coming to merchandise imports, imports of the country. Imports, merchandise imports grew at 68.9%. This is the growth rate. Merchandise imports growth rate. And coming to POL, that is petroleum, oil and lubricants imports. So coming to POL, there was a significant rise in the crude oil prices. We have discussed about it already. So because of this increase in crude oil prices, the POL imports, the value has increased by 119.2%. And the reason is because of the increase in crude oil prices. And this is very important to remember that crude petroleum continues to be the highest imported commodity. So highest imported commodity is crude petroleum. And in the last year, we have seen a sharp rise in the gold imports as well. Now this is again very important. Top import sources for India. Last class we have seen the top export destinations for India. So we have seen that three top destinations: USA, UAE and China. The same three are the top import sources but in a different order. China is the first, second is UAE and third is USA. And China's share has reduced to 15.5% of total imports from the earlier 17.7%. Then top 10 suppliers: China, UAE, USA, Saudi Arabia, Iraq, Switzerland, Hong Kong, Indonesia, Singapore, South Korea. So these are top 10 suppliers, but remember at least the top 3. India had the most favorable trade balance with USA. So this is very important to remember. The most favorable trade balance. Now what is meant by trade balance? Trade balance means the difference between exports and imports. Export minus imports. And a favorable trade balance means exports are higher than imports. That is in a positive way. So trade balance is positive. That is exports are higher than imports. And the most favorable trade balance was with USA. Need to be remembered. Second is Bangladesh and third is Nepal. Now coming to trade in services. So trade in services, India's service exports recorded a growth of 18.4%. So this is the service sector growth, service sector export growth. Then coming to the total service exports, the commodities or those services that constituted the highest: computer, business, transportation service. Three of these components or three of these subsectors put together, they constitute more than 80% of total service exports. So out of the total, 80% is constituted by these three: computer, business and transportation. Then coming to key reforms undertaken by the government: liberalizing other service providers, announcing reform package for telecom sector. So these are some of the government initiatives, and these initiatives have helped in improving the service exports from the country. Coming to service imports. Service imports rose by 21.5%. Increase by 21.5%. And let's come to the top components of service imports. Payments for business, transport, travel, computer services, they constitute more than 75% of the service imports. So these subsectors, these constitute the 75%. Coming to private transfers, as per Migration and Development Brief 35, World Bank data, India continues to be the largest remittance recipient country in the world. This is again very, very important. In the prelims examination, you can expect such kind of statement type of questions. So as per the World Bank, India is the largest remittance recipient in the world in the year 2021. On account of higher net services receipts and private transfers, net invisibles were higher in financial year 22. That is 21-22. However, there is sequential decline in quarter 2 due to higher net outgo from primary income account, mainly reflecting net overseas investment income payments. So, in the quarter 2, in the financial year 2021-22, in quarter 2, we see that there is a outgoing, net outgoing is high. Why? Because of an increase in the investment income payments outside. Coming to current account balance, we have seen what is balance of payment and current account balance, current account in the last video. So, I'm not going into it again. India's current account balance flipped into deficit of US $3.1 billion. So, we are having a negative current account balance. It's unfavorable, or we can say negative balance. It's a deficit. Now, a deficit means that the incoming is less than the outgoing. And this is 3.1 billion US dollars. This is 0.2% of our GDP. And the major reason is increase in merchandise trade deficit. One of the major factors why we have a current account deficit is because of increase in merchandise trade deficit. Next, we are coming to capital account. Net capital flows more than tripled. That is, it tripled by 65.6 billion US dollars, which is 4.5% of GDP. And we have already seen that during the COVID times, the capital inflows to the country has increased. So there is an increase by 4.5% of GDP. Foreign investment, consisting of foreign direct investment and foreign portfolio investment, is the largest component of capital account. So, capital account mainly consists of capital transactions, especially the investments, and two major components are FDI and FII. FDI is foreign direct investment, where the investors directly invest in companies in India. That is direct investment. Now, foreign portfolio investment is indirect investment, or we can say hot money, where the investors invest in the shares in a stock exchange. That is the difference. And FII and FDI has increased, and that's why the net capital flows has increased by 4.5% of GDP. The net foreign investment inflows, primarily driven by FDI, it moderated to 25.4 billion US dollars in financial year 21-22 compared to previous year. So moderated. So we can say FDI, with regard to FDI, there is a moderation as compared to previous year. Now, among the FDI equity inflows, the highest share was given to or was received by computer software and hardware. So computer software and hardware, they attracted the highest FDI equity inflow. And coming to the country, Singapore continues to be the top investing country in terms of FDI equity inflow, while US is in the second position. So these two countries are important and you need to remember it. Singapore followed by USA. These are the two countries in the order. Now coming to BOP balance and foreign exchange reserves. The current account deficit was adequately cushioned by robust capital flows, resulting into overall BOP surplus. In case of BOP, there was a surplus, whereas in case of current account there was a deficit. These two things needs to be remembered. And we have already seen it in the previous video that we have a massive increase in the forex reserves of the country. We are the fourth largest forex reserve holder in the whole world. Coming to exchange rate, that is regarding rupee appreciation depreciation. Rupee depreciated by 4.5% on a year-on-year basis against US dollar in 2020-21. And as compared to some other currencies, rupee appreciated against euro, Japanese yen, pound sterling. Now, these two things need to be remembered. So, depreciation is a reduction in the value of rupee and appreciation is an increase in the value of rupee. As compared to US dollars, rupee has depreciated, while against euro, Japanese yen and pound sterling, rupee has appreciated. And the rate of depreciation is 4.5% against the US dollars. Coming to net international investment position, India's net IIP in international investment position, it is 11.3% of GDP, and this is a sustained improvement. Coming to India's external debt finally, there is a rise in India's external debt, especially because of the COVID. The government had to invest more in the economy. So, the government had to spend more. Borrowings also increased. That's a major reason. Commercial borrowings constitute the largest component of external debt. This is very important. This was actually a 2019 or 20 prelims question. I don't exactly remember the year. It was a previous year prelims question. External borrowings. Commercial borrowings are the highest or the largest component, followed by NRI deposits and short-term trade credit. So these are the important items. US dollar denominated debt remained the largest component of India's external debt. This is also very important. In fact, this was also asked in the examination. External debt denominated in Indian rupee witnessed an impressive increase over the years. Why? Because of introduction of debt instruments which are denominated in rupee, like for example masala bonds, etc. So rupee denominated debt also increased massively in the previous few years. Persistent inflationary pressures in advanced economies, particularly in US, have reigned some fears of taper tantrum. So we have already seen it in the previous class that US, the inflation rates were very high. And finally, top 10 agricultural export products from India. We have seen that marine products constitute the highest, then rice other than basmati, spices, sugar, buffalo meat, basmati rice, then raw cotton, wheat, castor oil, other processed items. So remember that first is marine products followed by non-basmati rice. So you have to remember at least top 3. Marine products, rice and spices you remember. So that's it with regard to the third chapter, external sector. So in the next video, we will start with the next chapter. Thank you so much for watching. Wishing you all the very best.